You know, every trader thinks the market owes them something. Confirmation, comfort, a clean signal. But the market owes you nothing. It never has. And that's why today I want to talk to you about something most people never even notice on their charts, taking profit from the dead zone. And before we dive in, let me say, this idea ties naturally back to the previous video on why you keep losing even when your analysis is perfect, because the dead zone is exactly where perfect analysis gets most traders into trouble. Now, when I say dead zone, I'm talking about that stretch of price action where the trend hasn't died, but it hasn't lived enough to give you a clear next step either. It's that quiet middle ground where the tape moves slow, the public grows uncertain, and traders who don't understand the market's rhythm start making mistakes. Ever notice how your conviction tends to slip right there? Most traders keep waiting for the next big surge, thinking it has to move soon, but the market doesn't work off your expectations. It works off its own pulse. And if you don't learn to read that pulse, if you can't sense when the energy has drained out of a move, you'll give back much of what you earned. Let me ask you, how many times have you watched a winning trade shrink because you insisted on staying through the lull? I learned early in my career, back when quotations were chalked on boards and prices arrived with the pace of telegraph clicks, that the dead zone is the moment when professionals quietly step off the train. Not because they know the top is in, not because they see a reversal, but because they've seen the steam leaking out of the engine. The market is telling them the easy part of the move is over, and that's all they need to hear. Now, I'm not talking about panic selling. I'm not talking about dumping your position at the first pause. I mean studying the tape until you can practically feel when the crowd has exhausted itself. The public always comes in late. Professionals always leave early. That's one of the oldest laws in speculation, and it's in the dead zone where that law reveals itself most clearly. Think about it. Haven't you ever felt that subtle shift, where the market no longer pushes but merely drifts? Most traders don't trust that feeling. They think it's fear. But more often than not, it's awareness. Awareness that the sweet, clean part of the move, the part with real velocity, has passed. Your job isn't to grab every inch of a trend. It's to take the portion where the probability is most in your favor. If you insist on squeezing the last drop from every movement, the market will usually take back the bottle. And let me ask you something else. How many times have you been right on direction but wrong on timing? Because that's another thing the dead zone exposes. A market can still technically be in a trend, yet be entirely wrong to trade at that moment. That's where a lot of traders get trapped. They think trend. Following means staying in until the chart tells them otherwise. But charts don't speak English. They whisper. And in the dead zone, they whisper the quietest. You have to learn to look past the price bars and pay attention to the behavior behind them. The volume dries up. The range contracts. The tape hesitates. That's not the market reversing. That's the market resting in a way that doesn't reward riders anymore. If you were a sailor, you wouldn't stay on the water once the wind dies, just because the ocean hasn't turned against you. So why stay in a trade when the momentum that carried you there is gone? Some people call this taking partials, but that's just modern language for an old Livermore principle. Get paid while the market is still willing to pay you. I never felt the need to milk a move to its last tick. I took the meat of the move, the vital, energetic stretch where the market showed conviction. You can't force conviction where it no longer exists. Wouldn't you agree it's better to walk away with something certain rather than linger for something imaginary? And the dead zone reveals a lot about your trading mindset, too. Traders who feel compelled to stay through every inch of a trend are usually trading from necessity, not opportunity. They're trying to prove something, to themselves or to the market. But this game doesn't reward emotion. It rewards observation and discipline. Wealth building in trading is nothing more than repeating good decisions and refusing to let bad habits survive. So ask yourself, what does staying in the dead zone do for you? Is it discipline, or is it hope dressed up as discipline? Right around this point, You may realize how this ties back to that earlier video. Losing even when your analysis is right often happens because your timing gets tangled up in zones where the market temporarily stops paying traders who overstay. You can know the direction cold and still lose money if you don't understand when the move has already given you the best it had to give. A trend has structure, impulse, pause, extension, exhaustion. The dead zone sits between the extension and the exhaustion. It is that murky middle where the uninformed trader thinks he should hold tight, while the tape reader begins to lighten the load. Have you ever seen a chart where the price floats sideways after a big push, and instead of strength, it feels like a market catching its breath, and not in a healthy way? That's the zone I'm talking about. You have to train your eye to spot these subtle signs. You've got to look at how the price behaves at support, how it responds to resistance, how quickly it reacts when touched by new orders. A strong trend snaps back with force. A tired trend drags its feet. I used to say, a market that won't go up on good news isn't a market you should marry. The dead zone often shows you that exact reluctance. This is where patience becomes your greatest ally. Not patience to sit through stagnation, but patience to wait for clean, fresh setups. You don't want to ride the market through mud. You want to catch it when the road is clear. Isn't it better to step aside and wait for the next real opportunity rather than watching your profits erode while you convince yourself that who'll move soon? Most traders misunderstand patience. They think patience means staying in a trade forever. No, patience means staying out until the moment is right. It means letting the dead zone pass while preserving your capital and your clarity. It means letting the amateurs fight over leftovers while you wait for the next full course move. The dead zone teaches you to think like a professional, not like the public. It teaches you to take profits while they still belong to you, to step back before the market forces you out, to see the difference between a trend that's alive and one that's merely twitching. But to apply it, you need to let go of the idea that every trade must become a masterpiece. Some trades are just stepping stones in a much bigger campaign. And if you recognize the dead zone early enough, you can step off the field with your gains intact, your judgment sharp, and your confidence undisturbed. Taking profit when momentum weakens, not only when price reverses, is one of those trading principles that separates the students of the market from the victims of it. Most traders wait for a dramatic signal, some obvious candle pattern or a sharp drop, to tell them it's time to cash out. But by the time the market hands you a clear reversal, it's already reclaiming what you should have protected. The tape rarely rings a bell before it turns. It only softens, it drags, it hesitates. And if you're attentive enough, you can spot that fading pulse long before the crowd realizes the move is running out of breath. That's where the real edge lies, recognizing the quiet loss of power rather than waiting for the loud reversal. Momentum isn't just about price moving in your direction, it's about the quality of that movement. A strong market behaves like a confident person, decisive, consistent, and quick to respond. It pushes without hesitation. Every dip finds buyers, every rally finds eager follow-through. But once momentum starts to fade, the character of the move changes. The same pullbacks become sluggish recoveries. The same breakouts start to feel forced. There's no snap to the movement anymore. And if you've been trading long enough, you know that price action without energy is like an engine without fuel. It may keep rolling for a bit, but it's not going anywhere meaningful. Have you ever looked at a chart and felt that the market was still technically rising, but no longer acting strong? That feeling is exactly what most traders ignore. They confuse trend direction with momentum strength, assuming that as long as the trend points up, they're safe. But the market doesn't reward you for being technically correct. It rewards you for acting when the probabilities tilt. Momentum is probability in motion. When it weakens, your advantage weakens with it. You might still win, but you're no longer getting paid for the risk you're taking. That's why taking profit during momentum decay is not fear, it's discipline. And discipline pays far more consistently than hope ever will. The trouble is that weakening momentum doesn't announce itself with clean signals. It whispers through smaller candles, uneven pushes, and delayed reactions. It shows up in volume tapering off after a strong run. It appears in the tape when price touches levels that previously triggered sharp responses, but now barely provoke movement. Most traders chalk this up to consolidation. Sometimes it is, but many times it's the early stage of exhaustion, a sign that the easy part of the trend has already passed. Understanding the difference between healthy consolidation and dying momentum is one of the trader's greatest tests. And if you've held a trade during both, you know exactly how they feel different. Doesn't a tired market practically tell you it's tired if you're paying attention? Taking profit before reversal isn't about predicting, it's about observing. You're not trying to guess the exact top. You're simply recognizing when the market has stopped rewarding you at the rate it once did. Every trend has a sweet spot where the market moves in clean, decisive waves. Ride that part and you'll feel like trading is almost easy. Stay past it, and you'll feel the market start taking back inch by inch. Most traders get trapped right there. Not because they're wrong, but because they're late. They refuse to accept that the momentum they entered on no longer exists. They stay in because the chart still technically shows a trend, forgetting that the tape's heartbeat has changed. Another important point is that profits earned during strong momentum are more reliable than profits earned during stagnation. When the market is moving with force, you're aligned with the crowd that actually moves price, the big operators, the institutions, the professionals. But when the momentum weakens, those players are already stepping aside. The public becomes the last group holding the bag. If you're still in the trade during that phase, who do you imagine you're aligned with? It's certainly not the people who move the market. Momentum decay is also where emotion starts slipping through the cracks. When the move slows, uncertainty grows. Traders begin rationalizing. It's just pulling back. It'll run again. I'll give it a little more room. These are not strategic decisions. They're emotional negotiations with the unknown. And once you start that negotiating with the market, you've already lost the clarity you had when you entered. That's why taking profit at the first signs of fading momentum is also a psychological safeguard. It prevents you from drifting into hope-based decision-making. Let's also consider risk. A reversal can be sudden, sharp, and unforgiving. A loss of momentum, on the other hand, is often gradual. It gives you the chance to exit on your terms, not the market's. You're stepping off the moving train while it's slowing down, not while it's turning a corner at full speed. Isn't that a smarter, safer move? People often think that taking profit early sacrifices potential gains, but the truth is, late exits sacrifice certainty. The strongest part of any move is finite. Once the steam is gone, you're no longer trading momentum. You're trading hope, and hope doesn't pay consistently. Taking profit when momentum weakens means you're treating the market as it is, not as you wish it to be. It means you're choosing probability over perfection, discipline over greed, and clarity over noise. The dead zone is where trends lose conviction and profits quietly evaporate, and if you've traded long enough, you've definitely seen it, even if you didn't have a name for it. It's that stretch of price action where everything still looks fine on the surface. Trend intact, structure unbroken, direction unchanged. Yet the market somehow feels different. It's softer. It's slower. It's less certain. The momentum that once carried your trade effortlessly forward starts to fade, but not in a way most traders notice. They look for dramatic changes, sharp reversals, big red candles. But the dead zone never announces itself with drama. It arrives like fog, slow, subtle, and easy to miss until you're already inside it. And once you're in it, profits that looked secure begin to shrink without any real warning. The most dangerous thing about the dead zone is its quietness. Traders expect losses to come loudly, but many losses start as slow leaks. You enter a strong trend, you're riding a clean wave, and everything feels like it's working exactly as planned. But then the market starts pausing a little longer between pushes. The pullbacks deepen slightly, the rallies hesitate. Nothing technically breaks, but the character of the move changes. Ever seen a chart where the price keeps drifting upward, but no longer looks convincing? That's the dead zone playing its trick. It keeps you comfortable just long enough for complacency to set in. And complacency is expensive. The dead zone is exactly where traders start giving profits back. Not because the market suddenly turns, but because they don't recognize that the quality of the move has already deteriorated. They think, it's still in trend, so I'll keep holding. But a trend without conviction is a trend in name only. The professionals know this. They lighten their positions the moment they sense the vitality fading. They don't wait for a signal. They read the rhythm. They watch the tape. They see the energy draining out, even if the price still leans upward. Let me ask you, how many times have you stayed in a winning trade simply because the chart still looked technically fine, only to realize afterwards that the move was already dying long before the reversal? The dead zone is where the smartest players pay themselves quietly, and they do it without drama because they understand a deep truth: the easy part of the move is over. That's what the dead zone really represents, the end of the easy money in a trend. After that, every additional point becomes harder to earn and easier to lose. Most traders don't recognize this shift. They stay, thinking they're being patient. But staying in the dead zone isn't patience. It's ignoring the voice of the market when it's telling you the party's winding down. Another key point about the dead zone is that it lures traders with false comfort. The market isn't reversing, so it doesn't feel dangerous. And because the trade is still green, the trader's guard lowers. But profits can shrink just as surely during drift as during reversal. Sometimes they shrink faster, because traders refuse to act while the chart still looks okay. The dead zone is where traders talk themselves out of exiting. They say things like, it's just consolidating, or it'll break out again soon. But the tape's behavior tells a different story. A strong trend corrects with energy. A tired trend flattens out. When a trend loses its urgency, you should be paying attention. Doesn't every trade you've watched slowly melt away make a lot more sense through this lens? There's a psychological trap here too. Traders often think that exiting during the dead zone means leaving money on the table. But that's the wrong way to think about it. Exiting during the dead zone means taking what the market willingly offered before it changes its mood. The idea isn't to catch the whole move, but to participate in the portion where the market is rewarding you for being aligned with real momentum. Once the conviction is gone, you're no longer riding the wave, you're balancing on it. And balancing is not where traders make their money. It's helpful to see the dead zone as a warning light, not a reversal signal, not a danger alert, but a sign that the odds have shifted. All great trades have phases: the ignition, the expansion, the exhaustion. The dead zone sits between expansion and exhaustion. It's the plateau before the decline in probability. And this plateau is exactly where inexperienced traders think they're being strategic for holding. The truth is, they're no longer trading the trend. They're trading the leftover momentum of what used to be a trend. You can even see the dead zone in volume behavior. When a move begins, volume often increases. When it's in full stride, volume supports the continuation. But when the dead zone appears, volume doesn't collapse. It just thins. It becomes irregular. It stops confirming the direction of the price. The market moves, but without authority. How many times have you watched a breakout in low volume and felt uncertain, even though the chart looked bullish? That uncertainty isn't you being indecisive. It's you sensing the dead zone. The reason profits evaporate there is simple: the market lacks commitment. Without commitment, any random pressure can push price against you. And because the trader stayed in longer than the momentum justified, the market takes back gains slowly at first, then quicker once the trader finally realizes they overstayed the move. Being able to spot the dead zone means understanding the difference between a market that is moving and a market that is merely drifting. It means knowing when to take your money while it still belongs to you. It means seeing the hidden shift in market character before the crowd reacts. Most importantly, it means recognizing that trends don't end with reversals. They end with exhaustion, and exhaustion always begins in the dead zone, extracting the meat of the move. Not every last tick is one of those ideas that sounds simple but separates traders who last from traders who burn out. The market doesn't pay you for being perfect. It pays you for taking the high probability portion of a trend and stepping aside before the uncertainty begins. That's what the meat of the move is, the clean, decisive, high momentum stretch where price behaves with purpose. It's the part of the trend where the tape practically pulls you forward. But the moment traders start hunting for every last tick, they cross the line from professional execution into emotional ambition. And ambition, when misapplied in the markets, has a habit of taking back profits that were already earned. Have you ever held a trade past the point where everything felt good, only to watch the market drift against you until your once solid profit shrank into something disappointing? The meat of the move is where the inefficiency lies. It's where the market transitions from imbalance to clarity, where buyers overwhelm sellers or sellers overwhelm buyers, producing those smooth pushes that feel obvious in hindsight. It's the part of the chart everyone points to later and says, that was the real move. But here's the catch. Those stretches never last as long as traders wish. They burn bright and fade quickly. The public tends to arrive late, entering right when the professionals are preparing to exit, because the volatility and conviction that created the opportunity are already thinning out. Professionals know this, which is why they don't try to squeeze the last breath out of a trend. They extract the portion where the risk to reward is most favorable and exit before the market starts hesitating. Most traders struggle with this because of greed. Not outrageous greed, but subtle greed masked as discipline. They say things like, let the winners run, or I want to catch the full move. But catching the full move isn't discipline, it's fantasy. No one consistently captures entire swings. Not Livermore, not Wyckoff, not modern traders with all the technology in the world. The idea isn't to catch everything. It's to catch the meaningful stretch where momentum is strongest. And the moment you start trying to milk the last part of the move, you're working against the natural rhythm of the market. Doesn't it always feel like the reversal comes right after you convince yourself to hold for just a little more? A trend has a life cycle. Early stage, strong expansion, late extension, and eventual exhaustion. The meat of the move sits in that middle stage, the expansion. It's where price runs cleaner, pullbacks are shallow, volume confirms the direction, and the tape feels energized. Once the move shifts from expansion to late extension, everything becomes harder. Pullbacks get deeper, candles get smaller, the tape becomes uneven. Instead of smooth continuation, you get choppier swings. The market starts handing out warning signs, but traders ignore them because they're hypnotized by the unrealized profit on their screen. They think, it's already gone this far, why wouldn't it go a bit further? But trading isn't about what could happen, it's about what's probable, and probability shrinks the moment you leave the meat of the move and enter its tail. The irony is that taking the meat of the move produces better long-term results than trying to catch entire swings. It's counterintuitive. Traders think that holding longer leads to bigger profits. But in practice, holding through low-quality sections of a move increases drawdown, reduces consistency, and exposes your account to unnecessary noise. Over hundreds of trades, extracting the clean middle produces steadier results with far less emotional strain. You're avoiding the chop, the exhaustion, the conflict zones where big players unload positions and late traders rush in. You're choosing the high probability core over the messy leftovers. Think of it like a hunter who takes the shot only when conditions are perfect. The edge isn't in firing constantly. It's in waiting for clarity, taking the advantage when it appears, and stepping back once the conditions decay. The market rewards decisiveness, not stubbornness. Trying to capture the whole move is stubbornness disguised as ambition, and the market loves to punish stubbornness. Focusing on the meat of the move also builds a healthier trading mindset. When you stop trying to hit home runs on every trade, you start valuing steady growth over dramatic wins. You stop expecting the market to give you more than it's offering. You stop getting emotional about missed profits because you know your job isn't to take everything. It's to take the part where the risk makes sense. And that shift in mindset does something powerful. It reduces the internal pressure that leads to reckless decisions. When you accept that you're only after the meat, the temptations of squeezing more, holding longer, or hoping the market gifts you an extra push weaken significantly. Haven't you felt how much clearer your decisions become when you're not chasing extra inches? Another reason traders struggle to stick to the meat of the move is comparison. They see charts after the fact and feel regret for not holding the entire way. They see social media screenshots showing massive runs and think they should be doing the same. But hindsight is dishonest. It hides the emotional difficulty of sitting through consolidation, hesitation, and near reversals. It hides the part where conviction fades and uncertainty grows. It hides everything except the final outcome. Trading live doesn't give you that luxury. In the moment, you must rely on behavior, not hindsight, and behavior is clearest during the meat of the move. The market doesn't pay you for predicting the future. It pays you for managing the present. The meat of a move is the present at its most favorable. Past that point, you're trading a shadow of what was once strong. Extracting the meat means acting while the opportunity is vibrant, not when it begins to decay. It means respecting the rhythm of the market, rather than imposing your expectations on it. It means stepping off the ride while the market is still paying you willingly instead of waiting until it has second thoughts. Strong setups return. Dead zones don't reward overstaying. And if you've spent enough time watching charts breathe, stall, and surge, you know how true that really is. The market is a cycle of opportunities, not a single opportunity stretched thin. When traders cling to a position that has already given them its best phase, they forget one of the quiet truths of trading. High-quality setups come back, but the dead, tired parts of trends rarely give you anything worth holding for. The mistake happens when a trader treats a fading setup like it's the last bus of the night. But in trading, there is always another bus, another wave, another clean stretch of momentum. The only question is whether you'll still have the clarity and the capital to catch it. Have you ever regretted exiting a tired trade early, or have you more often regretted staying too long? A strong setup has a certain character to it. It shows conviction. It shows pace. The price moves with intention, not confusion. You can see buyers or sellers stepping firmly into the tape. You can sense the imbalance in order flow. That's what makes a setup strong. Not just the chart pattern, but the energy behind it. When a setup is alive, the market pushes in your favor and barely gives you trouble. You don't have to babysit the trade. You don't have to negotiate with yourself about what to do next. The market carries you. That's when trading feels straightforward, almost simple. But once that phase ends, the nature of the setup changes. Even if the chart structure is intact, the momentum isn't. The tape becomes sluggish. Pullbacks lose their sharpness. Breakouts lack follow-through. It's like the market is breathing shallowly instead of deeply. This is the dead zone creeping in. The setup didn't suddenly become bad. It simply lost its vitality. And vitality is what paid you in the first place. The key insight most traders miss is that you don't need to cling to a setup that has run out of gas. Strong setups don't appear once in a blue moon. They appear regularly, rhythmically, across time frames and market conditions. But to take advantage of them, you must exit the dead ones before they drain you. Emotionally and financially, the dead zone isn't harmful because it reverses sharply. It's harmful because it wastes time, attention, and often profits. It stalls you. It traps your capital in a place with low payoff. And because you're stuck babysitting a position that isn't doing anything meaningful, you miss the next powerful opportunity forming elsewhere. Traders often talk themselves out of exiting simply because a trade isn't losing. They think, no loss means no reason to close. But break, even or slightly positive trades sitting inside the dead zone are not assets. They're distractions. Strong setups reward you quickly, consistently, and clearly. Dead zones do none of that. Instead, They tempt you to believe you're being patient when really you're being passive. They encourage you to justify inaction. And while you sit there waiting for life to magically return to your setup, the market is quietly printing better opportunities without you. You've probably noticed that when you're stuck in a dead zone, you start thinking differently. You analyze harder. You squint at the chart. You force narratives. You think maybe it's collecting liquidity, or maybe it's building energy, or maybe it just needs time. But have you ever asked yourself why strong setups never make you go through mental gymnastics like that? Strong setups don't make you justify anything. They show their intention in the tape. They move. They progress. They give you feedback. Dead zones give you silence. The trader who understands that strong setups come back doesn't fear exiting early. They know momentum is recyclable. They know capital is fluid. They know patience is best spent on waiting for clean entries, not waiting inside dead trades. This is what separates a mature trader from an anxious one. The anxious trader imagines scarcity, believing they must squeeze everything from their current position because opportunities are limited.